Today, folks, we're talking about 3 stocks that I bought. I divvied up $6,000 that I distributed through my TFSA, my tax-free savings account, which if you are Canadian, this is the definition of tax-free income in perpetuity for the rest of your life. Something that would have Kevin O'Leary's mouth drooling. So I had to top it up. I do it at the beginning of every year. If you want to learn how much you can contribute to this account, I highly recommend going onto Google, searching CRA login. That's Canadian Revenue Agency login, where you can actually see the contribution limit to your RSP in your TFSA. I am not contributing to my RSP yet, not in a rush to do that because it's a retirement account, whereas your TFSA you can draw against at any given time. So I always take precedent over that. And then we're going to discuss how I have been able to outperform the market substantially over the last 4.5 years in this account. I just calculated that my average return has been 43.69%, which is just nuts. I mean, I'm up 200% in 4.5 years. So we're going to get into that as well. If you guys appreciate the clarity of my transparency, consider hitting that like button, because before we dive into that account and actually show you guys the positions, the cap gains, let's talk about these 3 stocks, starting with the smallest position that I purchased, which is MPW, Medical Properties Trust. This is a REIT that I only recently started adding thanks to somebody from our chat group that brought it up, started falling in love with this company. It is not back to its all-time highs, but this is a triple net lease structure in the hospital real estate market. It pays a really healthy starting 4.8% yield, which, by the way, I have to pay foreign income tax on. So even though this is sheltered in a tax-free account because it's a REIT, it's in the US, I'm going to pay 15% withholding. But because this yield is so high, I don't mind losing about 15% of it because it's just great monthly cash flow. So I only picked up, I think, about $400 or $500 worth of this stock just because it was the capital that I had left over. And I love this company, man. I feel like it just gives me proper diversification in the real estate sector of my portfolio. They have 444 facilities, 9 countries, kind of just generalized between general acute care hospitals. So that's just you going in, general cold, getting yourself checked up, behavioral health facilities, inpatient rehabilitation hospitals, really neat stuff with that one, long-term acute care hospitals. And again, when I mean triple net lease, guys, it basically just states that they are just allowing these hospitals to do their thing. The hospitals pay the rent, they keep care of the property and the building, whereas these guys kind of just own the property underneath that, just making the cash flow very conservative and predictable, considering they also have inflation baked into their lease structure, which just basically means year over year it's allowing them by contract to increase the rents by 2% based on the inflation rate, which it'd be nice if they could renegotiate that with the current inflation rates that we're seeing in the market. But damn, I'm really happy with the stability of this REIT's cash flow, leading us into numero dos. The second stock I purchased being a growth stock over a dividend stock. And I bought 7 shares of Facebook, kind of rattled around in my head that I really would like to own a little bit of Facebook within this tax-free savings account. I know I own a lot of it already, but because Tesla is flying, making up almost probably about 9% of my total portfolio, I was like, you know what? Facebook has a little room to get a little bigger here. And because it's still trading down, I just can't help myself. So I picked up 7 shares on this dip here, sitting, I think I bought it right around $3.39 a share, bought those 7 shares, which we'll take a look at in the account in a sec. But you guys all know Facebook. We're going back into this weird second major phase of this pandemic, which usually bodes well for the tech plays as everyone continues to do more advertising. People continue to sit at home and use social media more. We have the metaverse going on, talk endlessly about Oculus Quest 2 that I've been playing pretty aggressively here. Lots to be bullish on the next earnings, considering Oculus was the most downloaded app over the holidays. So we'll see how that looks into the earnings report that comes out toward the end of January here, leading us into the third stock I haven't purchased yet. I tried to purchase, but I forgot that the Canadian markets were closed today, and that of course being the Toronto Dominion Bank. TD sitting at all-time highs. I do not like paying these premiums for these banks, but they're like Pokemon cards to me. I'm trying to collect them all. TD needs to be scaled up. These will be the last TD shares I probably purchase for a while as I continue to begin to focus on Royal Bank, which means I have Bank of Nova Scotia. I've got Toronto Dominion Bank here. I've got Canadian Imperial Bank, and I have Royal Bank. Royal Bank now being the smallest position of all of them in which I hold. Canadian banks, as I say, guys, banks are banks are banks. Very boring, nothing to get excited about here, but it makes me happy because that cash flow has been really reliable. And now, even though I'm not sure how this pandemic is going to affect the banks, they did come off that recent shutdown period the government put on them where they weren't allowed to do buybacks or dividend increases, whereas now they are allowed to do dividend increases, which they did a 10% bump pretty much across the board. And on top of that, hopefully we see some more share buybacks. There's lots to be generally bullish on, considering these banks basically outperformed the S&P 500 over the last year, which bode very well for the return that we're going to be discussing in a second here, guys. I mean, take a look. TD's up 34.81% in last year, well outperforming the S&P, especially when you pop on that dividend yield. So let's get into this account, guys. As again, being a Canadian, I highly recommend that you go and open one of these accounts, talk to a tax advisor, talk to an investment advisor, anybody you can, just to get you into this account, because there's nothing better. It's like winning the lottery. You contribute this with your own capital, but again, perpetuated income with no taxes, obviously with a few exceptions coming from foreign withholding tax. But other than that, those are very minimal payments to what you'd have to pay on income tax. Take a look at this account. It's worth $172,920 as of today, folks. Absolutely incredible. Here's the extra income, about $2,900 that I'm looking to add to this TD position to get it to be worth about $10,000. Keep in mind, I do own more TD in my managed account outside of this tax sheltered account. But taking a look, I would like to start using the dividends that I get spewed off of these to maybe add another position. I kind of want to add a little more Algonquin power, but I realize I'm very concentrated in this account between utilities and banks. So I'm going to be looking at either adding RioCan back in or TELUS, which I both think are fairly valued here. But it's just a matter of starting to diversify this account. But I think I'm happy with my banks. They're going to give me that cash flow to start my diversification period this year. Going to the US side of the account, where I added Facebook first and foremost, guys, my 7 shares right around, $338.65. So not a bad buy-in price. I would like to add a lot more here, but I have to keep in mind that I own Facebook through all my accounts. I think I now own a total of 67 shares, and it is one of my second largest position next to Tesla as of this contribution. So I need to remind myself to take a breath, continue to diversify, but I had to get some of that in this account because I just think in the next 3 to 5 years, this could easily double, or I mean, it's going to do well in my opinion, but I can't put price targets on it because maybe it doesn't do well. Thus the reason of risk tolerance and not overexposing myself. But taking a look, guys, Medical Properties Trust has been doing very well over the last few months. It came back after being very volatile this year, but I'm up 10% on this position. Plus, it's spitting out a very healthy yield for me now. So, by God, no means complaining on that end of it. And other than that, I mean, take a look at these positions, guys. I'm very close to being up 1,000% for the first time ever on my initial Apple purchases. God, it's crazy to think I was buying Apple at $17 a share. I'm pretty happy with my VOO position. I just kind of added this to offer some stability and just kind of track my performance against the S&P. I think most people, and again, not being a financial advisor, do not buy what I'm buying, but just, it's usually good to have those kind of companies in these accounts because people forget that if you take a lot of risk on in a TFSA and you lose the money in this account, you lose that contribution room forever, which is kind of scary, right? Because you want to have as much capital in here to work with as possible, obviously because it's tax free. Now let's talk about the return. I might have to shrink my head here and move myself out of the way. Maybe I'll move myself down to the bottom corner. Now we're good. You guys can see what's going on here. So take a look at this. This is my primary account. It makes up the largest position, about half of my entire portfolio up against my other 4 accounts because I have a corporate account, I have a managed account, I have an RRSP account. So this account makes up more than half of my total portfolio, which is beautiful. And when I look at the performance of this, my jaw kind of hits the floor because this account has been around since June of 2017 to the end of December of 2021. This is the performance. This includes capital gains and dividends, total combined, nothing to do with contribution. So it's really interesting to think, guys, that in 4.5 years, I'm up 196%. Divide that out over that 4.5 years, we get a return of 43.69% against the S&P, which is just up about, what is that, in the same time period, just under 100%, about 90%. So it blows my mind that in this account, I have outperformed the basic indices, almost every fund manager that pretty much exists. I'm not obviously beating Kathy Wood's portfolio. I'm not as aggressive as she is, but I can't complain, guys. These are the likes of Ray Dalio, Warren Buffett kind of returns. Could you imagine perpetuating these kind of returns for 10 years? You become a millionaire very quick when most people are telling you to be conservative and focus on 10% returns being the average. So I I'm very pleased, very happy, very lucky. It's kind of nice having this Canadian and US counterparted portfolio and seeing how this kind of globally diversified portfolio can offer such incredible returns while also achieving very high dividend yields. My average yield on this account, I'd have to run the calculations, but it's high. I mean, it's definitely probably closer to the 4% range, which is wonderful. I mean, it's kind of nuts to think that you can get this growth of being a dividend-focused account. In fact, Facebook is the first company that I've added in quite some time that doesn't pay a dividend yield. So I think you can get the best of both worlds, still do very well. And again, not trying to boast or brag. I'm just trying to be 100% transparent, which is if that is something you guys appreciate, I'd highly, highly appreciate it if you just take a moment and hit that like button. Consider subscribing for future updates because God knows this performance isn't going to last. I don't know anybody that has kept up with 30 or 40% rates of return. In the early days, it's easy. Capital smaller. You can concentrate it with taking on less risk, especially being at my age, not even 30 years old. So lots of time to keep this concentration and continue to diversify it out as time goes on. And I look forward to keeping you guys updated as well. So let me know what you think. Let me know what you're buying in your TFSA and what your contribution room is. And I'd love to see how you're doing with that as well. So stay cool, stay awesome, and I look forward to catching you in the next one.